Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. It's one of the most maddening paradoxes in trading. You can be absolutely right about where the market is headed and still lose money. So, how does that happen? How can you correctly predict the destination, but get thrown off the ride before you even get there? You've probably seen it or even lived it. An analyst, maybe you spot the perfect setup. You enter the trade feeling confident. But then a quick, sharp dip goes against you just enough to trigger your stop loss. And then, mere moments later, the market snaps back and rips toward your original target, without you. Your analysis was perfect. Your timing, however, was not. Here at TRADEVERSE, we unpack the hidden systems that dictate these outcomes. Because this isn't about luck. It's about understanding the market's underlying structure, its psychology, and ultimately, the power of precision. The heart of the problem is a conflict every single trader has to face. This costly paradox between having great analysis and having flawed execution. Let's take the story of a trader we'll call Ethan. For months, he was trapped in this exact cycle. He'd do his homework, his research would point to a clear direction, but then he'd chase a rising price, totally gripped by the fear of missing out. And of course, the market would pull back just enough to stop him out and then mockingly continue on without him, exactly as he predicted. You see, his analysis was his greatest strength, but his emotional timing was his greatest weakness. So all these repeated failures forced him to ask a really important question. Is timing the market just random chaos? Or is there actually a systematic blueprint for finding the most efficient moment to make your move? Well, the investigation points to a very specific, structured answer. And that answer is a concept known as optimal trade entry, or OTE for short. Now, this isn't some crystal ball. It's not about predicting the future. It's a system designed to help you find the point of maximum efficiency after the market has already shown you its intentions. The main instrument we use for this is the Fibonacci retracement tool. It's a staple of technical analysis. And really, all it does is measure the depth of a price correction. Think about it. After a big move up or down, markets rarely just keep going in a straight line. They pull back. They retrace. This tool simply measures how far that pullback goes. Now, when you use this tool, there are two levels that are critically important. The first one is the 61.8% level. This number marks the beginning of the zone, the area where a pullback is considered deep enough to get the big institutional players interested again. The second key level is 78.6%. And the area between these two numbers, between 61.8 and 78.6, that is what many traders call the sweet spot. It's the zone where the odds of the original trend resuming are at their highest, giving you a really well-defined, low-risk entry point. So, now that we have the concept down, let's deconstruct the precise blueprint. How do you actually find and execute one of these optimal entries? The process has 4 clear steps. First, you need to identify a strong, powerful price move that just took out a bunch of stop-loss orders, what's often called a liquidity grab. Second, you look for what that move left behind. Typically, it's a price imbalance or a fair value gap, where a price moves so fast it was inefficient. Third, you draw your Fibonacci tool from the very start of that move to the very end. And the final, most crucial step, you wait. You wait for the price to pull back into that 61.8 to 78.6% zone. That is your target area for entry. Let's look at a quick case study on the Euro/USD. The old way, the trader, driven by FOMO, chased the price and got in at market. The result? A predictable loss. But by applying the OTE method, the trader did the exact opposite. They placed a patient limit order right inside that optimal zone and just waited for the price to come to them. And the result was a calculated, successful trade. This is so much more than a technical adjustment. It's a fundamental change in philosophy. Your goal is no longer to chase after the market. It's to find a precise spot on the map and wait for the market to arrive. You're shifting from being reactive and chasing to being proactive and patient. But here's where we level up. A single tool is rarely enough for a professional approach. The pros look for confirmation from multiple, independent sources. This is a principle called confluence, where several different factors all align to point to one high-probability opportunity. So a truly high-probability setup isn't based on one thing. It's based on a checklist. Was there a clear liquidity grab? Check. Is there a visible price imbalance? Check. Does our optimal entry zone line up with that imbalance? Check. And finally, is this whole setup happening near a major historical price level? When you can answer yes to most of these, you're not just taking a trade anymore, you're executing a high probability plan. In this case study on GBP/USD, we can see all four factors coming together perfectly. You have the liquidity grab as price swept the highs. Then, the imbalance created by the sharp move down. Third, the Fibonacci OTE identified the 78.6% level sitting right inside that imbalance. And finally, the key level. The entry point was right at a known historical resistance area. All signals aligned. That is a textbook execution. But knowing the technical side is only half the battle. Beyond the charts and the tools lies a much bigger challenge, the psychological discipline to actually follow the plan. The battle isn't just with the market, it's with your own impulses. Just look at the difference. The impulsive entry is all about chasing price. It's driven by emotion, and it means taking on high, undefined risk for a low probability shot. The precision entry is the polar opposite. You're patiently waiting, you're driven by confirmation, and you're accepting a clearly defined risk for a high probability outcome. One is a gamble, the other is a calculated operation. There's a quote from a trader's journal that just distills this entire philosophy perfectly. It says, "The market rewards patience, precision beats impulse. Let price come to you." It's this deep understanding that the market doesn't reward speed, it rewards precision. And often, the most powerful move you can make is to do nothing at all and just wait. Of course, there's a danger that patience can turn into procrastination, a fear of acting, even when the setup is perfect. The only solution is a rigid set of rules. 1. If your defined setup appears, you must take the trade. 2. You have to accept the risk before you enter. Losses are just a cost of doing business. And 3, you have to treat every single trade, win or lose, as just a lesson, a piece of data to help you improve. When it all comes down to it, the search for a real trading edge doesn't end with some secret indicator. It ends with a system. It's about making that disciplined shift away from random, emotional decisions and toward a structured, repeatable process. That is what separates speculation from professional execution. Which leaves us with a final question to think about. Is the key to navigating these markets some hidden, complex formula? Or is it simply a framework of unflinching discipline, patiently applied, over and over again? The evidence seems to point to the latter.